minimum tax. This amendment was introduced by Finance Act 2019. So there are 3 companies that are not liable to minimum tax: small companies, companies within the first 4 years of commencement, and agricultural company. But please note that being exempted from minimum tax is not automatic. Section 55 provides that any company that fail to comply with the provision of Section 55, fail to file their income tax return, even though you are expected to claim to enjoy minimum to be exempted from minimum tax, the moment you fail to comply with Section 55 of CETA, the benefit to be exempted from minimum tax will be withdrawn. That means if you are a small company and because of that you fail to file your income tax return as and when due, the law says that the minimum tax exemption will be lifted, it will be withdrawn. That means you will be liable to minimum tax. That is what section 33 of CIT provides for minimum tax computation. So I think I've talked about amortization. So I think yeah, so the last one here is what we call other statutory levies. Apart from your TET, we have what we call the Police Trust Fund, we have the National Information Technology, the NITIDA, we have the NASENI. Please note that small companies are exempted from education tax. Note that small companies are exempted from education tax. Also note that non-resident companies, foreign companies, are also not liable to education tax. For Police Trust Fund, all companies are liable to Police Trust Fund, which is simply 0.0005% of your profit before tax, PBT. So it means that a company might not have income tax but might have Police Trust Fund levy to pay. We also have NITIDA and NASENI. For you to be able to be liable to NASENI or NITIDA, you must have a turnover, not gross turnover of 100 million naira. And not all companies are liable to NASENI and NITIDA. For NITIDA, companies that are into IT, bank, they are liable to NITIDA. For NASENI, oil and gas company, they are liable to NASENI. Maritime, aviation are liable to NASENI, right? So not all companies are liable to NITIDA, and not all companies are liable to NASENI. But for PTF, all companies are liable to PTF. So not to waste our time, just to take more questions. So I think we've gone to the end of the webinar. Thank you.
So thank you so much. Thank you so much, Idris. That was a packed and mind-blowing session. Like, you cooked and you ate 100%. So to reemphasize on one of the points that you made, the part where you said there's no ignorance in the law. Honestly, there's no ignorance in the law. There's nothing like I was not aware, I don't know how to file, I was sick, so nobody was able to file on my behalf. Nothing. Like, the law is not going to take any of those excuses. So we just have to do right by the law. So guys, please can we appreciate Idris? I would like to see your clapping reactions. Please, let's appreciate him. He has really tried for us this evening. The value he was dishing out was no different from the ones that we pay for. But here we are giving it all out for free. So please, let's appreciate him. It's not easy at all. Okay. Thank you. So before we move on to the question and answer session, first question, Idris, please, would we be getting the slides of this presentation after the session? Please let us know if you will be open to sharing your slides or not, so we know what to do.
Yeah, it's fine. I'll be here. I'll be able to share it.
All right, thank you. So guys, you're going to get the slides after the session. So now this is how the question and answer session is going to go. For the sake of time constraints now, we'll be taking 5 questions in all. 3 people can unmute their mic and ask their questions, while we will be taking 2 questions from the chat box. I think I can already see 1 question, so I'll just go ahead and read that one. We are taking just 5 questions in all because we have another speaker that we have to bring up. So in order not to take much of our time, that's what we're going to do. And those that are asking their questions, please, you just have 30 seconds to ask your question. Just 30 seconds, please. And Idris, just try to answer as briefly as possible. So we move on to our second speaker who is already waiting for us. Thank you. So let me read out the question in the chat box first of all. So Taiwo Bello said, I work for a UK firm whose clients are basically in UK. It is also registered in Nigeria, but no operation. Its staffs are in Nigeria. Okay, its staff are in Nigeria, and we file payee. Is such company expected to file corporation tax in Nigeria? I think she meant to say, is such company expected to file CIT in Nigeria? So, Idris, over to you.
Okay, yeah, that's a brilliant question. But I think the answer is gladly, written on it. Yeah. So you already said it is also registered in Nigeria.
Yes.
Now, operation or no operation, as a company registered in Nigeria, you are automatically liable to income tax in Nigeria. You're expected to file your income tax return. Now, let's assume that such company is not registered in Nigeria, was probably company is a UK firm, and it has staff here in Nigeria. So we need to establish 2 things here. UK has a DTT, an active DTT with Nigeria. So we might now have to look into, because when a foreign company operates in a country that has an active DTT with Nigeria, we step the CIT aside and we look into the DTT to take precedence. So in this case here now, right, such company might be liable to income tax in Nigeria because the employees in Nigeria might create permanent establishments if they do business in Nigeria on behalf of the foreign entity. But the fact that they have a company registered here in Nigeria as well, operation or no operation, they are liable to income tax return.
Okay.
So you can say, oh, they've not commenced, right? Probably they are incorporated. You are supposed to still file something.
Okay. All right.
I don't know if I'm clear.
Yes, thank you so much. I think that's clear. And I hope Taiwo Bello gets the answer he or she wants. So far I can see we have 2 hands raised, Joy and Lekon. So, okay, who's going first? Joy, please unmute your mic and ask your question. You have 30 seconds to do this, please. Hello? Okay, she's not ready. Lekon, you can go ahead and ask your question.
Yeah, good evening, everyone. Thank you, Chizoba. Thank you, Idris. Zoba, please confirm you can hear me.
Yes, I can hear you loud and clear.
Thank you, Idris, for the great session. You're fantastic, actually. So, I would say, when it comes to the computation of your income taxes, so I would like you to take us through the deferred tax computation and the methods we have, and the various stages of impairment and escutment when it comes to your tax computation. So my questions are in 2 forms. So I want you to take us through just a brief ride on the deferred tax presentation and how it affects your income tax computation on the long run. Then also our impairment stages according to IFRS 9 and its effect or its effect on our income tax computation also. That's just what I want to know. Thank you.
Okay, thank you, Lekon. Yeah, so if I get your question right, the first one has to do with deferred tax computation, and the other question has to do with the tax effects of the impairment stages. Yeah, as read by IFRS 9. Yeah, good.
Definitely,
So
definitely.
yeah, so for the deferred tax computation, right? The reason, the basis, right? The situation where you have a deferred tax is when your accounting profit is not the same with your taxable profit. It means that there are difference, right? Or there's difference. Then you now drill down. These differences here, are they permanent difference or temporary difference? How are you going to know if they are permanent or temporary difference? For example, if that expense that is disallowed, if peradventure in the future it's going to come back as allowable expenses, it means that you have only deferred that obligation to the future. So that might be giving you a deferred asset. So an example is depreciation. We all know that in most cases, our depreciation rate is not only the same with our capital allowance rate. So let's say in a year, a company expensed 20 million as depreciation amount, and the FRS has given the company 15 million as capital allowance to claim. When I'm computing my CIT liability, I'm going to add back my depreciation of 20 million naira, and I will claim 15 million as capital allowance. It means that my accounting profit can never be the same thing with my taxable profit. There will always be 5 million naira difference. Now that 5 million difference here, am I going to claim these expenses, this allowance back in the future? Yes, because the same cost that you are depreciating is still the same cost you are claiming capital allowance on. So in that case, that 5 million naira give rise to what we call, because you have claimed less, give rise to what we call, deductible temporary difference, and that will give you a deferred tax asset. Now, why are you computing deferred tax? Because of IAS 12. IAS 12 provides that your income tax expense or credit that goes to your SOPL, right, is a product of your current tax provision and your deferred tax movement. So I hope I'm able to answer the deferred tax aspect, or you still need me to discuss more on it later. Okay, good. Yeah. So
Yeah, thank you.
yeah.
You've nailed it. You've nailed it already.
Okay, good. Now, from the angle of impairment, we need to understand that there are two different types of impairment. I want to talk about impairment of financial instrument and impairment as impairment of your assets. The normal impairment we know, which is IAS 36. It has different treatment with the impairment under IFRS 9. The impairment under IFRS 9 is the impairment of financial instruments. And financial instruments could be financial assets or it could be equity, right? So in this case here, under IFRS 9, there are 3 stages to impairment. Now, before you can allow an impairment, it has to pass through the 3 stages. An impairment in the first stage should be disallowed because it is still a mere provision. And the impairment is something we call ECL, expected credit loss, in IFRS 9. So in case you see ECL in your financial statement, it has the same treatment with impairment. But the impairment can only be realized when it has passed the 3rd stage. So that is the work of your auditor to examine, to test, using the IFRS 9 testing, right? IFRS 9 provision to test whether that impairment has passed the 3rd stage of impairment. If yes, and the auditor can certify that it has passed that, then it is allowed for deduction. But if no, you have to disallow it. So I hope I'm able to answer your question, Lekon.
Thank you. You've done well. Thank you.
Okay.
All right, thank you so much, Idris. Let me take
I
one other question from the chat box.
Okay.
Okay, this person said, my question is regarding setup registered under business name or enterprise that make above 25 million naira annually. how is their tax assessed, especially in a situation where the business owner pays payee? So I think it's basically around business name and enterprise. Person is not sure if they will still need to pay CIT or something. So it's saying, how is their tax assessed?
Okay, thank you, Chizoba. So, like I've said ab initio, right? Companies income tax applies to corporate entities. Now, I need to make this distinction. Enterprise, business name are regarded as unincorporated entity, while corporate entities are regarded as what we call incorporated entity. So, for business name and enterprise, it means the same thing. So, business name or enterprise, partners in partnership, they are all liable under the Personal Income Tax Act, the PITA. So, as a business name or enterprise, you don't have anything to do with company's income tax. Why? Because we cannot distinguish the owner from the business. So, whatever income made by the business, it becomes the income of the owner and will be liable to personal income tax. Payee is not PITA. You have to know this. Payee is more like withholding tax that is collected from employees. So a business owner will be liable to personal income tax and not payee, and even not company's income tax. So as an entrepreneur, a one-man business, you have nothing to do with company's income tax. Yours is just to file your PIT returns annually. Annually, yes.
Thank you so much, Idris. So Joy, we can have you now. You can unmute your mic and ask a question. Thank you. But if Joy
All right.
Okay, Joy is ready now.
Okay. Good evening. Hope you can hear me.
Yes, I can hear you loud and clear.
Thank you to the presenter. We are really grateful. My question goes this way. Under the companies exempted from tax, I was actually expecting to hear hospital. I learned about agriculture, so I really want to know if hospital are exempted or not, and if they are not exempted, please, other than payee, I would like to know the circles around, as in the tax liable to them. Thank you.
Okay, yeah. So thank you, Joy. Now, if we go back to my previous slide where I talk about property exempted, we talk about ecclesiastic, corporate society, but never mention hospital. Hospitals are not exempted from income tax. They are liable to income tax. However, if you notice that the medical fees are not liable to withholding tax except consultancy. So they are not exempted from income tax. Hospitals, they pay, private hospitals pay their income tax normally. Now, what are the other taxes they pay? For hospitals, medical equipment are exempted from VAT. That means if you are buying your drugs and other medical equipment from your suppliers or your vendors, and your vendors charges you VAT, don't pay, because medical equipment are not liable to value-added tax. However, if you are also rendering consultancy service, medical consultancy service as part of your activity, the consultancy service itself, right, might attract VAT. So I think that's it.
Okay, so Joy, are you clear?
Yes. Thank you so much. Thank you, sir.
All right.
Yeah. So Chizoba.
Yes, please.
So I think I saw about 2 questions on the chat box. Is this something I can attend to?
Okay, yes.
Okay, yes.
You can speak to them.
Okay, so I have Majaluato. She asked that, can I talk about the e-invoicing? Yes, I'm talking about, so that's going to be the last thing I'm going to talk about now. Then we have Oluwatobi. He says that, let's say correction of 2023 levy already in audit adjustments for the current year. Is it to be allowed or disallowed? Note, if your company is subjected to tax audits or debt review, what have you, and you're expected to pay, to pay your liability from the audit, such amount is not allowed as a deduction for CIT purpose. You can't allow it. Why? Because that amount was what you were meant to pay ordinarily if you had assessed yourself appropriately. So taxes paid cannot be an allowable deduction. It is not allowed. So I think that clears it. So to Oluwatosin John. So the e-invoicing, right, is actually, it's a new system whereby FRS is trying to, streamline the way companies issue their invoice and how they can easily track the appropriate tax, which is VAT. So instead of companies generating their normal invoice through their ERP software system or manually and putting VAT on it, now you can do that on the e-invoicing. But FRS, as there are two platforms to it. It's either FRS, they install that software in your own ERP system in your organization, or FRS is going to provide another platform, more like the Tax Pro Max, that every company can have, login access to create their invoicing directly. So the moment, as soon as they're generating the invoices on those platforms, automatically it will be reflecting on FRS dashboard. So instead of you doing it manually yourself and not even doing it appropriately, right? It reduces so I think it starts from companies with turnover of about 5 billion naira. So companies that are expected to adopt this e-invoicing now are companies with turnover of 5 billion naira. So for companies making below that, they are not expected to adopt the e-invoicing for now. I hope I'm clear.
Yes, you are very clear to me. Okay. So I think there's two persons, they have their hands raised. Idris, are we taking more questions?
It's fine. Yeah, I'm seated.
All
Yeah.
right, please unmute yourself and ask your question. 30 seconds, please.
Okay, thank you so much, Isoba. Thank you very much, Idris. Please, you mentioned something about hospital that their supplies they are not expected to pay VAT when they buy equipment from their
Medical
company.
equipment, yes.
So their services, is it vatable? Like a company that is into cosmetic surgery, do they pay VAT on their services?
Yes, cosmetics. Yes, for cosmetic surgery is liable to VAT. Yes.
Okay,
Yes.
thank you. Because I have someone that is into cosmetic surgery and he wants to know if he should pay VAT
Yes,
on the
liable.
service.
It's liable because of the intention behind it.
Okay, thank you.
Yes.
All right, so Oyedare and Yola, please unmute yourself and speak.
Good evening. Thank you to the host and presenter. Thank you so much. So I just want to gain clarity on amortization. You mentioned that amortization is an allowable expense. And for me, I need clarity on that because I'm sure that I've seen cases where FIRS, they've actually disallowed it. And I understand your bone of contention that since there is no capital allowance in lieu of depreciation, then amortization should be allowed. But I feel that amortization is also more like a provision, like an estimate. So which is why it's not like a re-expense, which is why it was disallowed. So I just want to hear your thoughts to that. And my second question is might not be a question. I just want to know if we are going to get the recordings. Thank you.
Okay. Thank you, Oyedare Enola. Yeah. So the first question, yeah, I will ask you a question, and you're gonna give me the answer to the question. We all know what an intangible asset means, right? And examples of intangible assets. Let us assume a company has a software, they bought software. Obviously, it's an intangible asset. They bought a software as a product. The cost is much, and they cannot, obviously, they have to capitalize it because of under IAS 38, right? Now, ICCA provides that you should amortize intangible assets. What you are amortizing, what you are spreading, is the cost that you've incurred on the software over the useful life. So are you telling me that when I'm computing my income tax, I should disallow the cost that I have incurred? Because FRS used to disallow depreciation, and depreciation is similar to amortization. So we need to understand the concept behind why they are disallowing depreciation. And the reason is not far-fetched. The reason is because FRS has given us another, rate, a different nomenclature to replace depreciation. And that is because they want all companies to have uniform rates on the same class of qualifying capital expenditure. So if I have incurred an intangible asset, I've incurred cost on it, and I'm spreading the cost over its useful life, it is never an estimate. What I've only done is that I don't want to claim all the whole cost in 1 year. Now I have to spread it over the useful life. Then let me claim it. So if FRS insists that no, you have to allow amortization, because okay, if that's the case, the cost I have incurred on software, how should I claim it? There should be something in place of it. So I can give it a different name, but I have to claim that cost because the cost is an eligible business cost. And again, the division is never an estimate. It's not an estimate. Division is the allocation of the depreciable value of a tangible asset over its useful life. What you only done is you spread the cost of the asset over useful life. So it is never an estimate, it's an actual cost. I hope I'm clear. And for the second part, Chizuba is going to answer that. I don't know if they'll release the recording.
All right, thank you, Mr. Idris.
Yeah, thank you so much, Idris. And to your question, we are working on that. Hopefully, if we're able to sort out the recordings, we will share with you. But as for the slides, you are definitely going to get that. All thanks to Idris. So do we have any more questions? I can see one in the chat box. Akinwale Mary. He said, please, I want to know more about Tax Pro Max platform. Okay, I don't have to explain this now. We can't really, due to time constraints, we cannot run you through the whole process of filing CIT on Tax Pro Max. I'm not sure we can do that step by step right now because of time. Maybe next time we could just hold another section just to handle that one for pure beginners who are still new to the platform. But we are sorry, I'm not sure we can take that right now because time is already fast spent, and we have another speaker who is to come up right about now. So I believe with this we can proceed to our second speaker for this evening, the person of Mr. Balogun Razak. So in a few minutes, let me just read out his bio. Balogun Razak is a results-driven tax professional with 5 years of experience in taxation and accounting. He has a proven ability to navigate